It's an exciting morning, and it's a little bit different than what we're used to on IPO. So just take us through the steps that are happening right now as we await this opening trade.
Yeah, I think the biggest difference is with an NYSE direct floor listing, that price discovery is happening here on the trading floor, unlike with an IPO where there are shares issued the night before that really creates a price that investors are using to determine, the value of a company. That's happening right now. So that's what that crowd is doing over there, trying to figure out where is supply and meet demand and have some stability in that opening price.
Something else that's going on here is they don't know how much is going to be sold, which is different than a typical IPO. I mean, I've talked to, what are they called, arrangers or whatever they're calling themselves, not underwriters. They don't know as of this morning how much could be sold.
Right, that's why a direct listing doesn't work for everybody. One of the important things you have to have is a distributed shareholder base, because you want to have enough people that can sell into the trading this morning that you have natural liquidity. So companies that have very few shareholders probably aren't candidates for direct floor listings.
We just talked to Bob Greifeld, ex-CEO of NASDAQ. We've talked many times to Tom Farley, your predecessor. I mean, they are both strongly opinionated that this is the way to go, direct listing versus traditional IPO. Do you think one is better than the other?
There are advantages to a direct listing if it fits your profile. So like I said, you have to have shareholders. So you need to have some liquidity day one. So if you're a company that doesn't have that, you're probably not the right candidate. But if you think about the reasons why companies go public, it's access to capital, having branding and visibility of a public offering to attract customers and investors, and then also to have a liquidity so their employees or early investors have money and can actually use their shares. And fourth is the currency level. Having a currency so you can engage in M&A. So for that access to capital, if you don't need money right away, right now, then you could consider a direct listing as long as you have enough shareholders that will provide some liquidity. But it doesn't mean that you don't need to raise money. So you can raise money down the road and have a better experience there because you're not leaving money on the table through the more traditional IPO process.
For the specialists here, how is it different? How is today different for them than it would be on an IPO day?
The process and the mechanics are the same. What's different is there wasn't a trade last night that really informs investors of what the current valuation is. So we set at the exchange a reference price so that to be used by the industry today, one, for their technology systems that need a price in there, and two, to give investors kind of a sense of what was private market trading like. But that's over a period of time. It's not like an offering that traded last night where shares traded hands. There is no transaction that's based on. So it's really very different from a just level setting perspective. That's why you'll see that range. Now they've published a range of 30-34 as the first indication that the stock might open in, but they want to give investors time to consume that and really see where the settled price is.
Is that why it takes longer?
Yeah, that is why it takes longer, because you're not coming into it with, hey, shares traded hands last night at this specific price. So they want to make sure that people have time to react.
They don't have a lockup here either, though.
Yeah,
right?
there's no lockup period.
I mean, if 3 days from now this price is really high, you may see a bunch of venture capitalists who thought, well, I wasn't really going to, may say, hey, I'm getting out now.
Yeah, you run the risk that there could be more volatility in a direct listing because there aren't any lockups, but you also don't then have that selling pressure when a lockup period expires later. So it's just about timing.
I mean, if I'm an investor sitting at home looking to get into the next hot IPO, does it matter whether I buy into a direct listing or traditional IPO?
No, I mean, with the exception of the fact that it could be a little bit more volatile, you want to make sure you understand, the market risks in general. They're no different, but investors have access. Frankly, a direct listing offers more transparent access to everybody at the same time, right? And that's one of the advantages.
You think Spotify opened people's eyes to some degree?
I do. I think Spotify had a really unique idea that accomplished what they were trying to achieve at that time. They didn't need to raise money right then and there. They could raise it down the road. It's important to recognize that one of the benefits now of being public is they have access to capital whenever they want and whenever they need it. And it's not just through secondary offerings, but through bond offerings and convertibles. There are other things they can do.
So when new issues come to market, what percentage do you think are going to be direct listings over time?
I don't think it's going to become the norm. Like I said, you have to have a broad shareholder base. You have to have brand and visibility that you're not really kind of needing that from 10%? The road show. But I think there are at least a handful that may follow suit.
A lot of people mention Airbnb, which I know you probably won't comment on.
Yeah, I'm not going to comment on a specific company, but I think those are the things you want to look for. One of the things I'm most excited about when I look at Slack today is that now, because they're public, other investors, the everyday investor, can share in their success as a company. And that's one of the things, I talked about the reasons why companies go public. I argue there should be a fifth one, that they allow everyday investors to share in their success. And when companies stay private, especially until they're very large companies, we're leaving that out. And I think it contributes to a wealth divide.
I mean, some of the performance of these IPOs have been incredible to watch. Beyond Meat up more than 500%. Zoom, CrowdStrike, PagerDuty, they're all up more than 100%.
Yes.
Is this healthy enthusiasm to you?
Yeah, I think if investors are excited about having access to these companies and about the plans they have for the future. So when there's a clear path to how they're going to be profitable, or if they already are profitable, and investors have that opportunity about they're excited about the addressable market they still have left to go out and attack, they're excited, and I think it makes sense.